rolling daily Forex versus quarterly Forex spread bets. Now, there are two forms of currency spread betting. The first related to the value of a currency at a future date, and the second is a rolling daily Forex, also known as a on-the-spot rate, which is intended for short-term trading. The spread price of a rolling daily is much lower than that for a future date price. At the time of writing, for instance, one spread betting company is quoting 24 points spread as opposed to a 40-point spread for future dates, or rather future rates. Spot daily Forex or rolling bets. Now, for shorter term positions, it can be better to use a spot currency bet or rolling daily bet. These follow spot foreign exchange trading in the interbank markets, close at 8 p.m. UK time, and settle at the prevailing spot rate, although it is possible to roll them over into the next day and at a small additional cost. Rolling spread bets are usually suitable for short-term trades of up to 3 weeks or less. Here's an example. Now, at the time of writing, Capital Spreads is quoting a spread on the pound against the euro of 1.1542 euros to 1.1545. You could buy at the upper end if you believe the pound will strengthen, or sell at the lower end if you think it will weaken. This means that the euro will be worth or is worth 115 pence with a minimum stake of £1 a point, which translates into an effective exposure of £11,545. Initial margin for this position can be as low as 40 times the stake. Let's suppose you bought at 1.154 euro on a £1 a point movement bet, and the pound strengthened until the spread being quoted was 1.1815 euro to 1.1818. You can then close your position by selling at 1.1815, and this would give you a profit of £270. Okay, now this equals 270 points, which is multiplied by your £1 a point stake. However, of course, if the market had moved against you, you would lose an equal amount. Forward quarterly Forex spread bets. Forward Forex bets are suitable for taking longer term positions of up to 6 months. In the underlying markets, a forward currency is an agreement of a rate today at which currencies will be exchanged on an agreed date in the future. The forward FX spread bets are very similar, except that rather than exchanging currencies, bettors simply expired based on the spot rate at 8 p.m. London time on the expiry date of the contract. With a quarterly Forex spread bet, you don't incur the daily financing charge, although the spread will be a little wider. Here's another example. Let's say the future rate of pound to US dollar is 19,910 to 19,922. Someone who thought that sterling would continue to strengthen against the dollar over the next 3 months could buy a forward Forex bet on the sterling dollar rate at 19,910 $19,922 for $2 a point. This bet would be equivalent to buying 20,000 pounds and selling at 39,844 in the foreign exchange market, and would require an initial margin deposit of just $600. Should sterling appreciate against the dollar and move to 19,980 to 19,992, the position could be closed at 19,980 for a profit of 58 points or $116. For more information, visit www.financial-spread-betting.com.